Hi everyone and welcome back to the Client Classroom. So when it comes to retirement, one of the things that takes people by surprise are taxes. And that's because a lot of people assume that once their paycheck stops, their taxes automatically go down. Well, sometimes they do, but not always in the way that people expect. So today I want to walk through a few of the most common tax mistakes I typically see in those first few years of retirement. First thing I see people doing is not planning for how withdrawals are taxed. When we're working, taxes are relatively simple. They're just withheld from our paycheck in most cases. In retirement, though, you're often pulling money from multiple accounts. It could be IRAs, 401ks, brokerage accounts, maybe even Social Security. Each of those things is taxed differently. So for example, traditional IRAs and 401k withdrawals are fully taxable as ordinary income, while brokerage accounts, well, they just may generate capital gains that have different tax rates. And Social Security can become taxable depending on your total income. So if you're not coordinating those withdrawals carefully, you can accidentally push yourself into a higher tax bracket. Second mistake I typically see is ignoring those first few low income years in retirement. In the early years of retirement, before required minimum distributions start, and sometimes before Social Security begins, those can be some of the lowest tax years of your life. These years can create opportunities for things like strategic Roth conversions, realizing capital gains at favorable rates, maybe repositioning some assets more tax efficiently. But if no one is looking at those years intentionally, that window can close pretty quickly. The third mistake I see people making is underestimating how Social Security is taxed. A lot of retirees are surprised to learn that up to 85% of their Social Security benefit can be taxable. And it's not taxed in isolation. It's taxed based on your combined income. So how you withdraw from your other accounts directly impacts how much of your benefit becomes taxable. And finally, forgetting about required minimum distributions. At a certain age, the IRS requires you to start taking money out of some of your retirement accounts, whether you need the income or not. If you don't plan ahead, those forced withdrawals can create larger tax bills later in retirement. So there's a common thread here, and that's retirement doesn't automatically simplify your taxes. In a lot of cases, it makes them more flexible, which is good, but it can also make them more complex. So here's the good news. With thoughtful planning, many of these mistakes are avoidable. So if you're newly retired or approaching retirement, this is the phase where tax strategy really matters. If you have questions about your situation, we're always happy to talk. You can schedule an appointment by giving us a call or visiting our website, caserta-dejong.com. We'll see you next time.